If you've been looking for specific places to invest your money to build your wealth, well, look no further, because in this video, I'm going to be going over some of the best ETFs to invest in to make some money. What's up, everybody? I am Jasprit Singh from theMinorityMindset.com, where money minds rethink rich. Investing in the stock market isn't always easy. I mean, the stock market is the most accessible place for somebody to go and invest their money to build wealth, but at the same time, so many people lose their money in the stock market because they either don't know how to invest their money in stocks, they don't know how to research stocks, or they get emotional, they buy a stock, they see it go down a little bit, and then they sell at a loss, and then a few weeks later, the stock pops back up. I knew I shouldn't have sold! If you don't want to spend all of your time researching stocks and picking stocks and keeping up with stocks, then another thing that you can do, instead of just trying to invest in individual stocks, is invest in something called an ETF, or an exchange traded fund. An ETF, you can kind of think of it like a basket of stocks, a group of stocks. Now what you're doing is, instead of trying to find the perfect company to invest in, you're investing in a group of stocks, which gives you exposure to a whole bunch of stocks. Now, if one of the companies in your ETF goes bankrupt, well, you're okay, because your ETF will have hundreds of other companies to make up for that loss. So even if one company goes bankrupt, it's not a big deal. But if you invest in one company, and this one company that you invest in goes bankrupt, now your entire investment is gone. The nice thing about ETFs is it makes investing a lot more passive for you, because now you don't have to keep up with every individual company. You just find the right ETF, you throw your money in there, and you keep investing your money every week or every month, and now you're just consistently building up this portfolio of this ETF or ETFs that you like, and this ETF is doing all the work to invest your money for you. Plus, ETFs work just like stocks. You can start investing in ETFs with as little as $100, and you can buy or sell your ETF whenever you want. But the whole idea about investing your money in ETFs, just so you know, is you want to be investing for the long term. So we're talking years now, where you want to buy something and you want to just keep investing in it and hold it for the long term. That way you allow the market to grow and your companies to grow to make you more money. Now, the thing that makes ETFs really interesting is you have different types of ETFs that give you exposure to different types of stocks. And in this video, I'm going to be going over 7 different types of ETFs with different ETFs within each type, that we can understand some of the best ways that you can go out and start investing your money and building wealth. So let's jump into these 7 types of ETFs. But before I do that, I need you to do me a quick favor and smash the thumbs up button below. And just so you know, if you are interested in learning more about how you can start investing in the stock market and start building wealth in the stock market, our team has put together an amazing guide on how to invest your money in the stock market. This guide will walk you through different stock market strategies and how to invest your money in the stock market and build wealth in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read our free stock market investing guide, I'll put the link to how you can download this guide in the description below. The first and probably the most popular group of ETFs are the ones that give you exposure to the S&P 500. So the S&P 500 is just the largest 500 companies in the United States that trade on the stock market. So if you are a company and you are one of the biggest 500 companies on the stock market, well, then you are gonna fall into the S&P 500. So this is literally just an index or a group of the biggest 500 companies on the stock market. A couple ETFs that will give you exposure to the S&P 500 are VOO and SPY. Small disclaimer, I do own shares of VOO. Now, what you need to understand about this is when you go out and you buy shares of VOO or SPY on the stock market, this is now an ETF. So when you buy either one of these, you're getting exposure to the 500 largest companies on the stock market. Now, you don't have to go out and individually buy each company. These ETFs are out buying these 500 largest companies, and they're managing that investment for you. So all you have to do is invest your money into here or here, and now you have exposure to the 500 largest companies on the stock market. Now, before I go any further, I gotta make sure this is clear. Investing money has risks. You are never guaranteed to make money when you invest. You might even lose money, so always do your own due diligence and never blindly listen to a random guy on YouTube. Everything that I'm talking about today are just examples. I'm not telling you what to invest in, and I'm not telling you where you need to invest. I'm giving you examples of how these ETFs work and a couple ETF examples, that way you understand where to look. But I want you to do your own research, because there are a ton of ETFs out there, so you gotta find what's right for you. So the thing that differentiates these 2 ETFs is, one, who manages the ETFs, and then what this ETF actually invests in and how much. So this is a Vanguard ETF, and this is a Spider ETF. What that means is Vanguard, the company, is the one that owns and manages this ETF, and Spider is the one that manages this. By the way, just so you know, Spider is spelled SPDR. are. Now, when we talk about what companies an ETF is invested in, you want to look a little bit deeper than just the companies, because what's going to happen is both of these ETFs are both going to be invested in the biggest 500 companies in the stock market, but one might be invested more in Microsoft than Apple, the other might be more invested in Tesla, and so they both give you exposure to the top 500 companies, and this is where you can do a little bit of research and see how much each ETF is invested into what. One of the easiest ways to do that is just to go to finance.yahoo.com, and then you can just enter in these two ticker symbols, and then you'll see, if you scroll down, you'll see some of the top companies that each of these ETFs are invested in, or you can go onto the Vanguard website or the Spider website, and they'll show you which companies these ETFs are invested in and how much. That way you can get an idea of which companies you're getting exposure to. Another thing that you can pay attention to when we're comparing different ETFs is the expense ratio. The expense ratio, if you go to finance.yahoo.com, you'll see it there. You'll also see it on both of these websites. This is how much money you're paying to have your money managed by this ETF. So the advantage with an ETF, especially a low-cost ETF, is you're going to pay way less money to have your money managed here than to have somebody physically managing your money with an actively managed portfolio. So these type of ETFs, these are passively managed, meaning they're managed by a computer. So all these ETFs are doing is they're giving exposure to the top 500 companies in the stock market. If one of the companies in these top 500 companies goes bankrupt or gets smaller, well then this ETF or this computer is just gonna kick out that company and it's gonna put in the next biggest company. That way your money is still being managed by the computer, but it's like an algorithm. It's gonna give you exposure to the 500 biggest companies. The expense ratio on both of these ETFs are very low. It's less than 0.1%, which means if you invest $10,000 into one of these ETFs, they're gonna charge you less than $10 a year to manage your money. But that expense ratio is definitely something you wanna remember as you start comparing more and more ETFs, and as we go deeper in this video, because you're gonna learn about different types of ETFs. And so if you're trying to compare different types of ETFs and see what's better for you, the expense ratio is something you should be paying attention to. The second type of ETF that you might want to consider is a total stock market ETF, kind of like VTI. So a total stock market ETF gives you exposure to the entire stock market. Previously, we talked about the S&P 500 index, which gives you exposure to the 500 biggest companies in the stock market. Something like VTI will give you exposure to the entire stock market with big companies, medium-sized companies, and small-sized companies. So now you're literally just investing your money in the stock market, and if the stock market goes up, your ETF should go up. The stock market goes down, your ETF in general should go down. So now you're essentially giving yourself exposure to the entire broad market. This is another Vanguard ETF. And the thing you gotta understand about this is if you don't know what sector to invest in or what industry to invest in or kind of a more generalized place to invest, then this might be a good place for you to invest, because now you're just investing your money in the stock market and you're hoping that the stock market will go up. So if you believe in the United States economy, then you should be believing in the United States stock market, which means that in the long term, the United States stock market should go up, and if it does go up, well then this ETF will give you exposure to that. The third type of ETF that you want to consider are high dividend yielding ETFs. So there's two ways that you can make money in the stock market. You can make money through appreciation, which is when you invest your money in a stock, you bought it for $100 a share, and then the price of the stock goes up to $200 a share, and then you sell. You just made $100 because the price of your stock went up. This is called appreciation. But the second way that you can make money in the stock market is through something called dividends. So at the end of the year, some companies have a lot of cash in their bank account. And when a company has a lot of cash in the bank, there's a few things that they can do with this money. They can save this money for emergencies, they can invest this money back into the company, or they can pay this money back to the investors. They can literally just give it back to you in a cash payment called a dividend. A good company should do all three. So a good mature company is gonna save some money for emergencies. They're gonna keep investing in their growth. They're gonna hire more employees. They're gonna open more offices. They're gonna open more stores. And then they want to reward their investors, their shareholders, people like you, for investing in and believing in the company. So this is where you have to understand what stage a company is in to be able to pay out a dividend. Because if we're talking about a small startup growth company, well, this company's goal is probably not gonna be to reward their investors, because their goal right now is to get as big as possible, as fast as possible. So what they're gonna be doing is not saving their money. What they're gonna be doing is not paying this money out to their investors. what they're going to be doing is taking all of their cash and more through debt and other investments, and they're going to be reinvesting it back into their company. They're going to want to get more users. They're going to want to get more customers. They're going to want to open more stores. So smaller startup companies are not going to be paying out dividends because they want to get as big as possible, as fast as possible, and every dollar that they have is going to be going right back into their company. But some companies, your more mature companies or larger companies, are going to have this extra cash pile because they're already very large. And at the end of the year, they're going to have a huge profit. And if they want to pay this money out to their investors, one way they can do that is through dividends. It's an actual cash payment that you get without even selling your stock. Now again, there's a couple ways that you can get exposure to these dividends. You can go out and you can individually invest in companies that are paying out high dividends, or you can invest in a dividend paying ETF. So if you invest in a company that's paying out a high dividend, well, now the pro is you'll be able to get a high dividend, and if you invest in a good company, the value of your company will go up. But now the risk is if this company starts to tank, if they are on the verge of bankruptcy, if they start losing money, well then they're going to be forced to cut their dividend and you can see their stock price crash. The advantage of an ETF now is now you don't have to worry about trying to find the perfect company again, because this ETF is going to give you exposure to a whole bunch of different high dividend paying companies. And now if one company tanks or goes bankrupt, you'll be okay because you're getting exposure to a wide range of companies. The con here is you're not going to get the highest possible dividend because some companies are going to pay a higher dividend than others, and your returns are also going to be averaged out because some companies are not going to do well, but other companies are going to do great. So the goal with an ETF is not to get the best return possible, is to get a slow and steady, consistent return through the market. A couple examples of ETFs that are focused on paying you dividends are VYM and RDIV. Again, these two ETFs are in the business of trying to get you high dividends. This is where, again, you have to know what your goal is as an investor. I know I've talked about this at least 100 times on our YouTube channel, which is why if you haven't subscribed to our channel, make sure you do that. But this is where you got to know your goal, because if your goal is to see your investment portfolio grow as big as possible, then you don't want to be investing in these high dividend ETFs, because these companies are now taking their money and paying it out to their investors instead of taking their money and reinvesting it back into their company. So what you want to do, if your goal is to see your portfolio grow as big as possible, as fast as possible, is not invest into these dividend paying companies. These ETFs are focused on producing you consistent cash flow. It's not going to be the highest cash flow possible, but their goal is to give you consistent cash flow that you can count on. Like what we saw happen in the 2020 pandemic was a lot of companies started to struggle. And because of that, lots of companies started pulling back their dividends. And so people who were invested into these companies that were paying out dividends, hoping for consistent cash flow, were then all of a sudden, almost overnight, left with no more cash flow coming in because lots of companies cut their dividends. And so the whole idea here is to get a safer, which also means lower return, but a safer, more consistent dividend income. The next type of ETF that you may want to consider investing in are emerging market ETFs. The whole idea behind this is, well, now you want to diversify your money outside of just the United States, because the reality is every economy has its own struggles and no economy can continue booming at a consistent rate forever. The United States is the leading economy in the world. The United States is the strongest economy in the world, but some people are naturally worried that another company is going to come around and their economy is going to grow bigger than the United States. Or they're also thinking that smaller countries around the world are growing faster than the United States right now, which makes sense because smaller companies grow faster than bigger companies. When you're this large, big behemoth of a company, it's much harder for you to invest in innovation and grow much bigger because you're already very large. But if you're a small company, well, now you have the ability to grow way bigger faster because you're small, and so you have a lot of opportunity to grow. It's the same with this here. When you're investing in emerging markets, the whole idea is you're taking on a little bit more risk because you're investing in new countries, things like China and India and Brazil. And what you're hoping for here is that these smaller countries are going to see economies that are going to grow faster because they're smaller and they have the opportunity to grow bigger. Plus, you naturally have some people that are a little bit worried about the long-term health of the United States economy. So they want to diversify some of their money outside of just the United States economy. And one way that you can do that is by investing your money into emerging market ETFs, because this gives you exposure to the economies of different countries around the world. Again, a couple examples of this would be VMO and IET. These are two different ETFs that give you exposure to emerging markets. Now again, this is where you want to do a little bit of your own research and see which countries each ETF is investing in and see what you'd rather have. Do you want more of an exposure to China or do you want more exposure to South Korea? And so you just gotta figure out what's important to you, because this ETF is gonna give you more exposure to China. This ETF is going to give you exposure to a broader range of countries. But now we're just getting into the details, because in either case, you're going to be getting exposure to emerging markets and emerging countries around the world to give you some diversity outside of just the United States itself. The fifth type of ETFs that you may want to consider investing in are innovation ETFs. We are in the innovation age right now, where technology is growing and innovating way faster than we've ever seen happen before. I mean, for all the 80s and 90s babies out there, you probably remember that when you were a kid, the internet wasn't what it was today. When you had to go on the internet back when you were a kid, you had to make sure that your mom or your dad wasn't on the phone, because you had to go through dial-up, and anytime you went on the internet, it was like, you remember that whole sound bite that you had to go through to get on the internet? Well, now look at how far we've come with innovation. And so if you want to invest your money into the future of innovation, then you can look at innovation ETFs. So some of the most popular innovation ETFs are managed through the ARK fund, which is managed by somebody named Cathie Wood. And Cathie Wood is now a famous investor because of the returns that she's gotten her investors. And just a disclaimer, I do have my own money invested in a handful of different ARK funds. But the whole idea behind these ARK funds, their symbols are all ARK, A-R-K, and then something. Like ARK-K is their flagship innovation fund. If you put in a G here, it's the Genome Fund. If you put in an F here, it's the FinTech Fund. They have a fund for space exploration. They have a fund for a lot of different things in the innovation space. You can just go onto the website and see the different funds that they are. But again, the whole idea here is you are trying to get some exposure into the innovation side of the world. Another thing that you want to understand about these is that these funds also come with their own fair share of risk, because you're investing in a lot of smaller companies and a lot of startup companies. And these funds are also more on the actively managed side, which means that you have people actively working to try to find the best companies to invest in. And so your expense ratio, remember we talked about that a little bit earlier in this video, is going to be a little bit higher here, because now you're actively paying somebody to help manage this fund. But if you're one of those people that wants to be invested into the innovation side of things, into the newer companies, into the newer technology, and you want to hope that one of these smaller companies takes off, well, then some of these ETFs might be right for you. The sixth place where you may want to consider investing your money in ETFs are REIT ETFs. I didn't write the word ETF. REIT ETFs. And what a REIT is a real estate investment trust. So for all of my real estate people that want to get exposure to real estate on the stock market, this can be a way for you to get exposure to that by investing your money in REITs. When you invest your money into a REIT, you're investing your money into a company that invests in real estate or that invests into mortgages. So you're not getting direct exposure to the real estate per se, but you're investing in the company that invests in real estate. So the whole idea is, if real estate goes up or if real estate is really booming, well, now this company is going to be booming because it's investing in real estate and you're investing in that company. So it's not a direct investment in real estate, it's an investment in the company that invests in real estate. A couple examples of REIT ETFs would be VNQ and IYR. Now, the thing that makes REITs interesting is REITs are required by law to follow something called the 90% rule, which says that REITs are required to pay out 90% of their taxable income or their profits to their shareholders, people like you, through dividends. And so a REIT's income comes through rental income, because these REITs own these rental properties, these investment properties, and they make money from rent. And then after they pay all their expenses, their management fees, their property insurance, their utility bills, their property taxes, their other fees, once they pay all their fees, then they take the rest of this income and 90% has to be paid out to people like you, shareholders, through dividends. An ETF's job, again, is to minimize the risk for you. So now instead of you trying to find the best REIT to invest in, now you can invest in a REIT ETF. That way we get exposure to a whole bunch of different REITs that we don't have to worry about trying to find the perfect REIT to invest in, because REITs do have a lot of volatility, especially the ones with the higher dividend yields. And this brings me to the seventh type of ETF that you might want to consider investing in, which are your growth stock ETFs. These are your companies that are trying to grow as big as possible, as fast as possible. And then within these growth stocks, you have your large growth stocks and your smaller growth stocks. Your larger growth stocks are a little bit more mature. These are your companies that might be making profits, that might be paying out small dividends, but they're still really investing in their growth. They're still investing a lot in innovation because they still want to grow bigger. So the first example of this would be investing in something like QQQ. So QQQ gives you exposure to the NASDAQ, which is essentially the 100 largest companies which are not financial. So this would be companies like Amazon and Apple and Microsoft and Tesla. A lot of these companies are tech companies, but when you're investing in QQQ, you're getting exposure to 100 of the largest non-financial companies, which many of them are in the tech space. On the other hand, you also have the small cap growth stocks where you can get exposure through something like SYLG. So SYLG invests into the smaller cap growth companies, and these are going to be a lot of companies that you might not have heard of. A couple popular ones are things like Crocs and maybe MicroStrategies, but the goal with both of these ETFs are to give you exposure to these growth type of companies. One gives you exposure to the larger cap ones. These are going to be more of the companies that you've already heard of. This one gives you exposure to the smaller cap companies, the smaller companies that are really fighting to become much bigger. Remember, more risk comes with more potential return, but you also have more chances to lose your money. This again goes back to your goal. What do you want? More risk comes with more potential return, but it also comes with more risk. Less risk compared to this comes with less potential return, but also less risk. Now, the key for any of these investing strategies to work that I discussed is you have to stay consistent and you want to keep investing your money, whether it's every week or every month. You want to keep investing your money into these ETFs. That way you can continue to build your portfolio of these ETFs. That way you can keep fueling the fire. And then you want to make sure that your fire has time to grow. The best way to build wealth in the stock market is to leave your money in the stock market for the long term, because the people that make the most money in the stock market are the people that invest for the long term. And remember, if you do want to learn more about investing your money in the stock market and some of the different stock market strategies out there, we got a free guide to investing your money in the stock market in the description below. Thank you for watching. If you enjoyed this video, here's a video on investments that you need to own for life that I think you'll love. And while you're at it, download our free stock market PDF. And as always, keep hustling. Sears used to be the monster retailer, and back in the day, people used to think that there would never be a Sears competitor because they were so huge. Well, now times have changed, technology has changed, and Sears is bankrupt.